Well, welcome everybody. Thanks for joining us for Startup Fundraising 101. I'm proud to be your host today, so let me introduce myself briefly. I'm Erick Brimen. I'm a co-founder and the CIO for Onevest. And let me just spend a minute or two sharing a bit about my background, as I think it will help inform my point of view, which is useful for this presentation. So when I went to school, I always knew I wanted to be an entrepreneur. So I chose Babson as my university. And as you know, Babson focuses on entrepreneurship. But my specific minors within that were finance and economics. I'm also a graduate of the Founder Institute, a great organization. If you haven't learned about it and you're thinking of joining an accelerator, highly recommend you take a look at that. Upon graduating in college, I guess, as many of you might have been with student loans and what have you, I actually not started as an entrepreneur, but I started in the corporate world in banking. I started with Brown Brothers Harriman, a private bank, and then I went into investment banking and management consulting before I really took a deep dive into entrepreneurship. I was able to pay off my loans and have a little bit of savings so that I could indeed start my entrepreneurial career, which I did, and I've had my fair share of failures and luckily some successes, and I'm now very proud to be part of Onevest, which I believe really leverages my financial background with my passion for entrepreneurship in really hoping to make a difference in the world of founders. Fortunately and unfortunately, I've had to go through multiple rounds of fundraising, so I know firsthand how challenging and time-consuming that can be, which is why I'm a member of Onevest. We wanted to help solve the major hurdle of fundraising in the early stage entrepreneurship space, and we'll talk a little bit more about that. But without further ado, let's just jump right into it. And I guess the first thing is that we're supposed to make this disclaimer, so I'll give you a minute or two or 30 seconds to review it real quick. Okay, well, so what's our agenda for today? We'll talk about 6 different points, and at the end, we'll open the floor up for Q&A. I will try to go through these slides at a relatively fast clip so that we have as much time at the end to answer questions as possible. We're going to talk about fundraising sources, some key terminology that I think that it's worthwhile discussing, and pros and cons of taking outside investment. How do you decide how much money to raise? What do investors look for? And last but not least, the Jobs Act and equity crowdfunding, which is obviously our area of expertise. So fundraising sources, and my colleague here just advised I turned off the video. I guess that helps with bandwidth, so give me 1 second. All right. Is that better, Tiffany? Good, thank you. So fundraising sources, these are all hopefully known terminologies. We'll be talking about each of these throughout the presentation: crowdfunding, friends and family, venture capital, bootstrapping, accelerators, customers, angels, and what have you. These are, you might be thinking to yourself though that venture capitalists and angel investors as the more well-known source of fundraising is probably the largest source of money for early stage companies. But in fact, that is not the case. If you look at in order of magnitude, the amount of money that goes into funding startups and where entrepreneurs get the money from, the largest source, as per the Kauffman Foundation, is founder savings. Second to that, credit cards. And then is when you start getting into the family and friends, sometimes banks, not because the banks will lend the venture directly, but because you can get a second mortgage in your house, or because you can get a personal loan or what have you. And then sort of at the end of this graph, the VCs and angels, so I've always thought that this was fairly surprising when you consider it. Needless to say, if you can avoid going down the path of raising capital through debt or equity, then you're always better off. We'll talk about that, the so-called bootstrapping and getting customer funding. So let's review briefly some key terminology. I won't delve into too much detail, but please take note of these if you want me to elaborate upon later in the Q&A. So a term sheet obviously refers to that either one or two pager summary of terms that are likely to be what sets the conditions under which an investor will come in. They are non-binding, so a term sheet, if you get one, doesn't mean that you are definitely going to get the capital. It's usually the first step that an investor will take towards indicating that they're interested and engaging into further due diligence. The so-called cap table, that's really just a ledger of all of your shareholders as well as option holders in the business. It's a summary of how many investors you've had over time, but also who owns equity in the business, such as the founders. The valuation of the company, there is the pre-money valuation and the post-money valuation, and this can get confusing at times. I know initially for me it was very confusing. And pre-money is how much is your business worth before any injection of capital. So if you were to get, let's say, $100,000 of money, and your business was worth $900,000 before you got the money, your pre-money valuation is the $900,000. And then your post-money valuation is the pre-money plus the new capital coming in, and that would be a $1 million post-money valuation. And what's neat here coming to dilution is that the percentage that you end up giving up is in proportion to the post-money valuation, not the pre-money valuation. So in this case, if you had an investor for $100,000 and your pre-money was $900,000, you divide the post-money of $1 million by the investment, which is $100,000. So that'll be a 10% dilution. Convertible note, I won't go into too much detail, but debt, it exists as debt to make it simple, but ultimately will convert into equity. You have equity that's common shares or preferred stock. Those are certain rights, specifically with regards to voting, and in most cases also with regards to economic preference, so that the holders of the preferred shares tend to get money first before the common shareholders get their money back. And then crowdfunding, equity versus donation. Just to be clear, there is a big difference in between Kickstarter and Indiegogo, for example, which are donation-based crowdfunding platforms, and platforms such as Onevest, which are equity crowdfunding, and you are giving up equity in return for the capital you're getting from investors. So let's run a quick poll here, and let's see how many of you have ever tried raising capital for your startup. You'll be seeing here on your screen a quick survey. Please take a second to answer it. That will help me understand what we have here in the audience. Okay, so looking good. We're getting lots of answers. Keep going. Keep going. By the way, I just want to point out we have almost 230 attendees currently on this webinar, so I'm really excited about that. Thanks for joining us, guys. All right, so why don't we go ahead and close the poll, and let's see what the results are. Okay, so almost half and half, 60% of you have not done fundraising before, but a good chunk of you have. Okay, well that's great. That helps me out a lot. So then this little scary looking graph, it's a question we often get. How long does it take to raise money? I guess, Brendan Baker here, who put together this graph, I love it. It did a great job because clearly talks about time, and if you look at it, it's 6 months. I think the rule of thumb that we should be considering here, it's 6 to 9 months. It is a long process. It's a long process. But more important than that, you might ask, why is it so long? And this graph helps a lot depict that. If you can see here, these initial nodes are people that the entrepreneurs tend to know personally, your first degree of separation. And the size of the bubble is how much money the investors end up putting in. and then there are lines in terms of connections, and you'll see, towards the right here, these larger size of investments. A lot of times, in fact, most of these, none of these, were connected in your first degree. But so it's important that if you are to follow the traditional path, it's a very time and painstaking process where you have to reach out to people, pitch them, then they might not be in, but they might put you in connection with someone else. So it takes a long time, 6 to 9 months of calendar time and countless hours of your own time. So, with so much of this in terms of effort, should you take outside investment? Well, there are pros and cons to this, obviously. But let me start off by saying that nothing beats generating your own cash flow, and in a way, using your customers to finance the launch of your venture. So if you don't need external money, my personal preference is don't take it. But there are pros to taking this money. For one, you can hire faster, which means you can launch faster and achieve your objectives sooner. You can experiment with more things because, as you know, at the end of the day, in the early stage, we are experimenting. We're testing different hypotheses out, and so if you have more money, you can test more of these out, which increases your chances of succeeding. And for sure, your investors, if you pick the right investors, can be a very important support. They can serve as advisors, they can serve as connectors, and they literally have an invested interest in you to succeed. And on the con side, obviously you give up some equity and ownership, which reduces your upside when and if you decide to exit. But even if you don't and you distribute dividends, you obviously will have to share that with your investors. If you already had other investors on your cap table, then every time you bring in new investors and you do more fundraising, then there's additional dilution, and that is a fair thing to do if you're giving equity to new shareholders, but depending on the terms, it can be painful. And then obviously the more people that are involved, the more people you have to answer to, the more people that might have to opine on the direction of the company. So it's no longer just you and your co-founders. Now you have to deal with your investors. But again, I think that if you pick the right investors, this is actually a net positive. So then how do you decide how much to raise? So obviously to do it or not to do it, and then if you're going to go down that path, how much to raise. So generally there's not an exact science behind this, but there's two approaches that you can think of. For one, how much money do you need to hit certain benchmarks? And this approach is very good because it requires a deeper level of thinking as to exactly the use of funds. And I think by and large investors like to see this. I think that they'll think about putting capital as a way to help lower some risks, help answer questions. And the right type of investors understand that you're not going to answer all the questions early on, but you need to understand what are you trying to achieve. So when you think about it from that point of view and you say, well, I want to get to C, well, what is A and what is A in order to get there? Part of it is hiring people, part of it might be spending in marketing and making investments into equipment or investments into knowledge, whatever the case may be. You might choose to hire an external firm for your initial development, with which you'll do an MVP and do some testing. Obviously, it depends a lot on what stage you're in, but ultimately, if you think about benchmarks you want to hit and then back into how much money you need to get there, that's a great way to be thorough on coming up with the amount of money you want to raise. If it's hard for you to come up with specific benchmarks because you might already have a team in place with an existing burn rate, so to speak, another rule of thumb in terms of order of magnitude is that you want to raise capital for what you expect you will need with your in the next 18 months or so, with 25 or so margin of safety to have wiggle room in case you have to make some new hires or something that you didn't expect on the revenue side ends up happening. So what do investors look for? I think in here, team, probably it's at the top, but honestly, the slide does not do it justice because the earlier you are in your startup, the more investors really want to know about you and the team. And ultimately, it's all about the team. All the other things are going to matter, but given the early stage of the company, the ideas might change, so-called pivoting. The traction that you might have, even if it's trending positively, it's likely to be a very, very small proportion of what is ultimately expected you will achieve. So all these things ultimately come down to team. It's very important that you take the time, not only for showing investors, but for your own sake, and for the sake of your venture, to make informed decisions as to the team, about the team that you're forming. You want to make sure you're complementary. You want to make sure that your partner is not just someone that you like and that you feel you can get along with in your social life, but is someone who really complements the business. Think about what the business needs and make sure that your team is well-rounded for that purpose. The idea is important. There have been several articles here of late that say that the pendulum has shifted too much away from the value of the idea. Don't overdo it. Don't think that just because you have an idea, that is the most valuable thing in the world. But do recognize that ideas are worth, a lot of value, because you might have a great team, but if you don't have a good idea to pursue, then ultimately you might not be going down the right path. Traction is important, and a large market opportunity is obviously important. And the competition matters, but depending on the space you're in, if you're coming up with a better, cheaper type of solution, the competition ultimately is just a benchmark that will help you get a sense for what you need to improve upon. So now you're going to be putting together a pitch deck. And before I proceed any further, I just wanted to mention that if you have any questions as we have gone this far into the presentation, please go ahead and start submitting them. My team here will be taking notes of those questions, and then they'll be sharing them with me in the Q&A section. So if you have questions, go ahead and start submitting them. All right, back to the presentation. Pitch deck, what to include. Think of this as 3 general sections: an introduction, some stats about the business, and then your financials. In the introduction, you want to talk about the team. And by the way, I should start by saying that clearly you won't always have the same amount of time to pitch. And I think it's good practice to have, a 3-minute pitch version, and then a more complete, 15 to 20-minute pitch version that goes into greater detail. But, for what it's worth, these are the general areas that are important. Your team overview. What is it your company does? It should be simple. Think about this. If you need to spend more than 15 or 20 seconds speaking about what it is your company does to get the point across, you probably have not refined the overview of your company yet. What is it? What's the problem you're trying to solve? It's important to first enroll your investors in the problem that exists currently that you're trying to solve. And how does your company propose to solve that problem? You should, in the stats, talk about market size, and this is something that might be subject to multiple ways of quantifying. But realize that your market size is not good enough to say, well, I'm going to operate in the United States, and frankly, every man, woman, and child could consume my technology, so that's my market. That's not really, going to fly. You have to be as granular as possible, and you got to think about who are the first customers that you're going to get. The first 100 customers, if it's in the consumer or if it's in the B2B space, who are the first 3 big clients that I'm going to get. And a good approach might be to think about what is likely to be most similar amongst those populations you're going after, and then use that as a way to quantify the size of your market. Another approach could be if there is already a competitor of sorts and they're selling something similar, well, how many competitors are there? How much can you get a hold of an estimate of how much they're selling? And that can be a proxy for the size of the market if you can get a sense for their market share in the space. So the more mature an industry, the more likely you'll find third-party reports that have already done a lot of the legwork for you. But my point here is that you need to be thorough so as to not lose credibility with the rest of your deck. This part in particular, the market size, is the one that I think entrepreneurs tend to exaggerate the most, and that really takes a chunk out of the credibility of the overall deck. Be thorough, be specific, and be prepared to justify the size that you have indicated your market exists in. Your competition is important. I wouldn't put all your competitors on this one slide. Pick the ones that are most relevant to you and try to differentiate yourself against them. Do have an appendix at the end with, if you will, most of the competitors, if not all, that you think are relevant and that you might be asked about. Something that really turns investors off is if they know of a competitor that you didn't know existed. So make sure you do your homework on this point. Traction, this is key. The more traction you can show, the lower the risk that the investor will perceive exists. And there are multiple ways of measuring traction. I mean, revenue obviously is one, but many times it's about the adoption rate of your users for your product or service. It can be not even that. It can be how many conversations have you already had with potential users, even if they haven't purchased yet. You might be very early on, but still be creative and show how much time and effort and ultimately what the results are that have come out from it. I was looking at a pitch the other day, and the primary point of traction literally was the number of conversations that the entrepreneur had, and a very neat way to quantify the sort of recurring themes. And that got the entrepreneur, I think, about $150,000. I don't remember, from the group of investors that they were pitching to. So, the traction is important. Be creative about what you show. Financial projections, here again, like with the market size, these tend to be, on the one hand, overdone. Don't spend too much time, thinking about every little potential detail and driver impacting your financial projections. That is going to change every day. So, don't go into too much detail where you're spending, frankly, probably wasting hours on end. But at the same time, don't just have a hockey stick projection saying that you're going to grow every year, 10 times just because. You have to, here again, I think what most investors are looking for is not so much the specific number, but how you got to that number. And they want to know that you are thorough, but that you can also not get lost in the details. So make sure that you take this as an opportunity to show them that as an entrepreneur, you understand how to strike a balance between the two things. A very key slide is the ask, right? I mean, so you've gotten their attention. Hopefully by now they're excited, and then you hit them up with the ask. What are you hoping to get from them? Obviously, money is the obvious thing that you're asking for, but perhaps you're asking for more than just money. Perhaps you're asking for an angel who can put $50,000 and have experience in the medical devices space, or $50,000 and be able to help you open doors with these top 3 potential corporate clients that you're trying to get into. You'll be surprised that if you do that, some people might even get more excited about investing because they know everybody could put in the money. But if they feel that beyond money there's a specific ask that you have that they can help you with, then that makes all the difference in the world. And obviously, very, very important, how will you use the money? I spoke about this earlier, but I cannot stress it enough. Raising 100, 200, 500,000, $1 million, whatever the amount is, just because is not going to get you there. Investors want to know that you've thought about how you're going to put their money to use in a way that creates value. So here again, you can provide the summary on this slide, but make sure that you've done the homework and you can justify why that use of money is the best way to utilize the capital. So, you've raised money. That's fantastic. Now what? Don't commit the mistake that so many entrepreneurs commit, which is they take the money, they go, and then they disappear until they need more money, and then they resurface. That's a big mistake for multiple reasons, and I'll explain. Communicate with your investors, keep them updated. The reason why not doing this is a mistake is because at some point, most of us will run out of money before the company is profitable, especially in the early stages. If you haven't been communicating to your investors, what have you been doing? Even if everything is going great, and you wait till when you need the money to contact them, you're gonna be under a lot more pressure, which means that they have the negotiating power. But B, it's gonna take you a lot more time to sort of catch them up to speed, to where you are, why you still think it makes sense, and in fact you're even more excited about the opportunity and what have you. That's one. But the other, and probably the more tragic one, especially if you're doing well, investors are likely to get it quickly and then support you. But you would have missed out. You would have had a big opportunity cost, if you will, all along. By keeping your investors updated with both the good, the bad, and the ugly, and telling them not only what you've done, but what you still need and where they might be able to help you. You'll be surprised. A lot of these individuals who have the capacity to back startups, they're very well connected, and or they're very knowledgeable about something that you might not even know about. So keep them up to date. That's a way to potentially tap into the resources beyond money, and that at times makes a bigger difference in your business. Focus on milestones. Don't just babble around, the good and the bad, and what you're happy about or what you're sad about. Talk about, look, what I wanted to achieve this last 3 months was A, B, and C. This is what resulted from our efforts. These are new milestones for the next 3 months, or for the next month, or however often. But it should, you should try to do at least a quarterly update. So for the next 3 months, my objectives are A, B, and C, and my asks from you are A, B, and C. And obviously, celebrate the successes. Remember that for most of the investors that will back you, it isn't just a financial return equation. They want to be part of what you're doing. So let them be part of it. Show them that you're happy, and you will always get more bees with honey, as they say. But don't overdo it. Remember, it's a long stretch. It's a marathon, not a sprint. So celebrate the wins and then get back to work, because you got a lot of it ahead of you. So the next topic of discussion is going to be about the Jobs Act. Before I start speaking about it, I would like to ask you all again to fill out this quick survey. How many of you are familiar with the Jobs Act? Take a second here, please, to take the poll and answer whether you're familiar with it or not. You don't need to be an expert, by the way. Just if you've heard about it, if you have a general sense of what it is, answer yes. If you've not heard about it, then answer no. Okay, we're getting some responses here. Let's keep going. A few more seconds. 5, 3, 2, 1. Okay. So what is the outcome? All right, so most of you have not heard about the Jobs Act. About 70% of you haven't, and only about a third of you have. Most Americans might have heard about the Jobs Act, but they don't have a clue. So for those of you who have, good for you, and for those of you who haven't, don't feel bad. So what is the Jobs Act? The Jobs Act, without being a legal expert and without going into too much detail, I'll just surmise to what is relevant for you as an entrepreneur thinking about fundraising. Basically, there's 2 titles to the Jobs Act that are most relevant to entrepreneurs. The first one is Title II of the Jobs Act, which changed the way in which securities laws occurs in the United States. Title II basically allowed for general solicitation, which means that you can now tell the public that you're fundraising. Believe it or not, and I know this might sound a little crazy, up until when the passage of the Jobs Act was regulated and implemented in September of 2013, if I remember correctly, it was illegal for you as an entrepreneur to tell individuals that with whom you did not already have a meaningful and pre-existing relationship, such as family and friends, that you were trying to fundraise. And this is because that was considered by the SEC as you offering securities, and that process is heavily regulated, and you could have gone to jail. I don't want to scare anybody here. Hopefully, none of you have run into that, but you could have gone into jail if you had been considered to be generally soliciting before the Jobs Act, and somebody lost their money and they sued you. You could have, not only had to pay them back, but probably gone to jail. So that's a big change, because as you saw on a previous slide, it's not just your immediate network that you're likely to need to talk to. It's an extended network whom it would have been difficult for you to try to say you had a pre-existing relationship. Do note, however, this is not legal advice, but choosing to do general solicitation does come with consequences. We would be more than happy to walk you through those if we ended up working together at Onevest, but it does not come without consequence. If you choose to go through general solicitation and you're going to market you're offering publicly, even if it's on Facebook, if you will. It doesn't have to be an equity crowdfunding platform. You're going to be faced with some restrictions, and you should think about those. I think, without giving you advice, we obviously believe that for a lot of businesses it makes sense. Now, the Title III of the Jobs Act, which is something that everyone's been talking about lately, was supposed to be implemented earlier this year. It's going to be pushed to next year, and hopefully it will be implemented by October of next year. What this does is that, in addition to being able to tell everyone about your fundraising efforts, you will also be able to receive money from anyone. And when I said earlier that doing general solicitation came with consequences, one of the biggest ones is that even though you can tell everyone, you can only take money from so-called accredited investors. There's a legal definition to that. Again, this isn't the the topic of the presentation. We won't go into too much detail, but you got to be thorough with that. Title III, as long as you're using funding portals, equity crowdfunding portals, if you will, you can take money from individuals who are not accredited investors. The exact details of Title III are yet to be determined, so this is just a very broad stroke sense of what we hope Title III will do, but obviously it can materially change the landscape of fundraising, where you can not only tell everyone but also receive money from anyone, even if it's in small quantities. So let's talk a little bit about equity crowdfunding, because I mentioned that equity crowdfunding is different than rewards-based crowdfunding or donations-based crowdfunding. And a lot of entrepreneurs ask us, well, if I can raise money on Kickstarter and not have to give up any equity, why the heck would I raise money on Onevest where I have to give up equity? And that's a great question. We get it a lot. And there is several good reasons. The first is that we see a lot of companies who do raise money on Kickstarter ultimately also having to do an equity round, because on Kickstarter, as you know, and Indiegogo, if you're pre-selling things or if you're offering rewards, many a times the money that you're raising goes towards delivering on your promise. And especially for consumer product goods, that has implications. Many a times the delivery schedules aren't met, the production costs might be different than what you expected. I mean, there's a whole set of reasons why you will need more money. So even if you use the donations or the reward-based crowdfunding platforms, you might end up needing capital in addition to that. So you're going to have to do equity fundraising anyways. And the power of crowdfunding is huge. Your efforts are one-to-one, but through the platform you get exposure to many investors. So the first one obviously here is that you want to promote your company to a larger pool of investors outside of your personal network, which saves you a lot of time and effort. This is true for equity crowdfunding as it is for rewards-based crowdfunding. But you see, number 3 here is that it is a very different dynamic for somebody to pre-buy your gadget for $50 or even $100 and then hope that you indeed come through and deliver it to them 6 months later. It's a very different dynamic than when you get a $5,000 check or a $10,000 check from an investor in an equity crowdfunding platform like ours, because it's not only a bigger amount of money in relative terms, but now these individuals know that they have an equity interest in your business, so they're going to literally be vested in doing the best they can, not just to sit around and see if you succeed, but actually support you. And this goes back to my comment about keeping your investors updated. These people will have a stake in your business, and the more people you have rooting for you because they have a vested interest, the better you are. And a lot of people misunderstand this, but that's a very powerful difference between equity crowdfunding and just regular reward-based or donation-based crowdfunding. Compared to trying to raise money from a traditional angel or a handful of investors, what number 2 here refers to is that in equity crowdfunding you can pool, right, dozens of investors, which to get to the same total amount of money that you need means that each of the individual investors can contribute less money, which gives access to more people. You're not just now going after very wealthy individuals who can afford to write you a $200,000 check as an angel, but rather you can talk to people who have decent paying jobs as long as they're accredited investors, and they can write you a $10,000 checks, and it's not an insignificant amount, but a lot more people can write a $10,000 checks than people who can write $100,000 checks. So there you have it. That's basically the key reasons why equity crowdfunding is attractive. So that's pretty much it for now. We'll be looking at questions, but just as we do that and I start reviewing some of the options, please visit onevest.com, learn a little bit more about us. We launched a portal recently called learn.onevest.com. I think you'll find great content there. It's all curated by the community. Feel free to create an account. It's a pretty cool software actually that helps get the right type of content for founders. Tweet about us and find us at Facebook as well. All right, so let me see here. If I turn on the video, you can see me answering the questions. I'm looking towards my colleague here. There we go. All right, so we got a question from Shia. How important is physical location of the team? If they work remotely with each other, a rural bad area, not in San Francisco, for example. Okay, so physical location of the team. I would say, all else being equal, obviously it's better to have your founding team in the same place, especially in the beginning. But a lot has to do with how the relationships got started. If you met someone for the first time because of wanting to start a company together, and you haven't worked with that individual before, then it's really important for you guys to create the opportunities to meet in person, ideally being in the same location. If it's somebody with whom you have a pre-existing relationship, maybe at a job or maybe a prior startup, and you already trust each other and you know how you relate, then being physically in the same location is not as critical. However, again, being in the same room, being able to, in a moment's notice, answer a question, or just to feel the energy with which things are occurring in the company makes a big difference. That's with regards to the founding team being in the same location or not. With regards to being in San Francisco, for example, versus another city, or let's just say a hub city, because I think New York can be a great place as well, Boulder and Denver, Austin. There's so many, entrepreneurial hubs, but let's just think about the biggest one, San Francisco and New York. How important is it to be there, and what type of difference does it make to you? I would say that in the beginning, not that much. And by in the beginning, I mean you're trying to get an MVP set up and you're trying to get enough validation to show that you are onto something. Obviously, this assumes that it's mostly an online play, that your geographic location doesn't play a major role in the cost of delivering your product or service. If you're in the business of shipping heavy things, then obviously you want to be close to your customers. But let's put that aside for a second. The typical benefits of being in these startup hubs is that you have a lot more access to talent. You have a lot more access to events and information of subject matters that you might be interested in. And most likely, there's a more vibrant investor community, whether they're angels and certainly venture capital firms. Most of these professional investors like to be in the proximity of the investments they make. But in the earliest of stages, you can be in the middle of America or in the middle of nowhere. If you have a good internet connection and you got the team and you can work together and you can start to show traction, that'll get you a long way. And of course, on Onevest, you can fundraise from wherever you are. You don't have to be in San Francisco or New York or any other major cities. You can be wherever you want, and you can reach investors anywhere in the United States, in fact, even the world. So let's see here the next question. From Pamela, can your company implement a combination of equity crowdfunding and angel investing and other types of funding? So can you do a mix? And certainly if you're working with Onevest, you can. We don't require you to only use us as the only way to fundraise. We do require to only use us as your only equity crowdfunding platform. But in fact, we encourage and we require that for your fundraising round, let's say you're doing $200,000 or let's say $300,000, we do ask that you have at least 20% or 25%, depending on the terms, already committed from another source. Usually this is family and friends or an angel investor. Why do we require it? Because we want to know that as an entrepreneur, you're able to convince somebody out there about what you're doing before we invest our time and efforts in helping you fundraise within our investor community. So the answer is yes, you can and you should, and then we might be able to help you. So another question from Peter. Presently, Pre-Jobs Act Title III, with equity crowdfunding, who is responsible for determining if an investor is accredited? Well, that's a good question, Peter. Basically, I cannot speak for everyone in the industry, but if you work with someone like Onevest, then we have the processes in place to verify that the investors are accredited. And we have likely done that already before the investor even shows an interest in potentially investing in your startup. But even if we hadn't, because there's this self-accreditation process and then there's the full accreditation process. So if the full accreditation process hadn't occurred, then we take that process onto our shoulders and we only let money from accredited investors be deployed. And we are heavily incentivized to do that because through our partnership with our broker-dealer, there's legal consequence if we don't do our jobs at trying to make sure that this is complied with. So I hope that answers your question. At the end of the day, though, Peter, make sure that you're taking a good look at this because you're the founder, and if there's a problem with the fundraising in your startup, it'll spill over to you one way or the other. So the next question from Quito. Can you give any guidance as to the appropriate level of detail when pitching potential investors on your milestone schedule and how you will use the funding? How far into the tactical details do you need to go? Well, that is a good question, and it's a hard one to answer because I don't think that there is an answer that will work across the board. However, like I mentioned earlier, part of what investors are looking from you is not just the specific milestones that you're trying to reach or the financial projection, is that you can balance enough detail with the high-level picture. Because if you're only high-level and you're not focused on the details, that's bad. You're going to make big mistakes that might cost everyone a lot of money at some point. And if you're only looking at the details, then obviously you'll miss the big picture. In terms of milestones, I would think about it this way, Quito. I would say, what is it really that you're trying to achieve high level, right? And that's your milestone. And then what are 2 or 3 key activities and areas where you need to invest effort in order to make that milestone, in order to achieve that milestone? You will probably have already thought about what goes into each of those activities, but I wouldn't spend a tremendous amount of time including that, certainly not in the pitch deck, and let the investors ask the question. And when they do, if they do, then you can run them through how you are thinking about implementing each of those towards each of those milestones. I know it's a little vague, Quito, but there's just not a straight answer. We're happy to connect afterwards if you want. Feel free to reach out to us. So another question from Spencer. If you're developing a new product, at what stage should you start raising money? Well, generally speaking, as soon as you can show that your product has validation. And generally speaking, if that's not a good answer and you can afford to delay that even further, the later the better. I started saying that ideally you don't have to raise money from external parties because that comes with several layers of complication. But I get it. I mean, I myself has had to raise several rounds of capital, and you don't want to put all your savings into your startup either. So when you think that you have enough progress with your product that someone who's not as passionately invested in it succeeding can be convinced that there's a fairly good chance of the product being adopted, then that's the time. And then in order to get there, obviously there are multiple things you can do. You don't like I mentioned earlier, you don't necessarily even have to have the product built. There's a lot of legwork that you can and should do before you even invest into developing the product. You need to go and talk to as many potential customers as possible. Make sure that you not only get the specs right, but that you get, that you're starting to get the majority of the people you're speaking with in that selected target market to say that they would indeed, buy the product or buy the service. And don't let it be just a generic, sure, I like it, I'll buy it. Put a price to it. Are you really? And how much are you willing to pay? because everybody's willing to pay for something that doesn't cost them anything. When you put a price tag to it, they'll start thinking a little bit better about it. Another thing you can do, by the way, I don't know what product you're in, but another thing you can do is to create a simple landing page and promote that in a similar way as you would promote your company's website when it's finalized. And not only just have a sign up button for your email, but indicate the price that you're willing to charge, or you're thinking about charging for that particular product, and then ask people if they want to be considered for the best first batch of products that you're going to be putting out there. That can be a really strong indication, because when you're speaking with people one-on-one, especially entrepreneurs, we can be persuasive with what we're passionate about. People can just go along and say, yeah, sure, I'll buy it, because you're there. But if you do it through a landing page and you're not there to have the same level of passion and enthusiasm, because that's not scalable, then what you're going to be left with is making sure that your value proposition is strong enough to surpass the cost of acquiring the product or service as you priced it. So those are just some suggestions. Generally speaking, rule of thumb, when you talk to a stranger and what you have convinces them that it's a good time, when they believe the product is going to work, that's when you should consider start fundraising. All right, so another question from Martin. How important is it for both founders to be full-time? Does it matter if one founder is full-time and one is part-time? Well, Martin, that's a great question. And often it is the source of so many partnerships falling apart because of the asymmetric amount of time and therefore risk that the founders are taking on. I don't think that there is a just one way of doing it. What is most important is that whatever approach is followed is fair. So, for example, it wouldn't be fair most of the time for a founder to be full-time, fully committed to the venture, and another founder to be part-time and dedicating very little time to the venture, and for both of you to have the same upside in the business. There are some cases where that might make sense, especially if the job in which one of the founders is involved is generating income that in a way is subsidizing the entire business, or if it's generating insight that you're leveraging for the entire business. But more often than not, those scenarios are really hard to come by, and you want to make sure that you have a fair structure for whatever it is that you're doing with your co-founder. I will point you towards a book I like, and the author is Mike Moyer, and the book is called, I think, Slicing the Pie. But the general theme of the book is about dynamic equity distribution, which is it's hard to do once you have a lot of employees and especially investors. But early on with just your co-founders is actually a very wise approach to how to structure the equity. And if you were to follow a model like what Mike Moyer suggests, then it becomes a lot less critical to fully identify whether you need to be both full-time or whether it makes a big difference for one to be part-time or not, because you will distribute equity dynamically over time in proportion to how each founder is contributing to the business. And the model takes into account not just time, but money, assets, relationships, etc. So really encourage you to take a look at it. The ideal scenario, obviously, if you have a founder, is that the both of you can go full-time and dive deep into it, because it will take a lot of work to get it off the ground. But only once you think it's the right time, only once you have validated that the idea that you're trying to pursue has legs, and you don't need to be full-time in order to do that. You can do that in nights and weekends. You can speak with people in your office or your friends. And it's a big commitment. Don't take it lightly. Only go full-time once you think that you're ready to do that. But hopefully both of you do it at the same time. All right, and by the way, we're running out of time here, so I'm going to take probably one more question. And the next question comes from Benjamin. And Benjamin, you're asking, do you have any recommendations for the chicken or egg problem? A situation where you need a large quantity of capital in order to finish the proof of concept that many investors will demand before they invest. Let me think about that. A situation where you need large quantity of capital in order to finish the proof of concept that many investors will demand before they invest. I wonder if the premise of the question is might be flawed, and please don't take this the wrong way. To validate proof of concept, more often than not, I'm trying to think here of scenarios where that would be necessary, but proof of concept, needing a lot of capital to do that, I can't think of many situations. I mean, if you were in a capital intensive industry, for example, surely it would take a lot of capital to build whatever you're building, whether it's a machine or what have you. But I mean, your question presupposes, I think, here that you have to build it in order to do a proof of concept. And I hope that part of the point that I've been making through the presentation has been heard loud and clear, which is there's so many other ways to get to proof of concept, and the easiest or the cheapest one, to some extent, is the good old hustle. Get on the phone, get in front of people, and you'll be surprised again how impactful it is for an investor to see that you have spoken with 500 people, right? And that you've been methodical about your conversations, and that you can show how the concept that you were proposing has evolved over time, and now you have gotten it to the point where most people you're speaking with are on board, right? That by itself will go a long way, and you don't need much capital to do that. And if you have that, then you can get the capital, and sort of you create the chicken before you expect the egg to come alive. So here we got maybe 30 more seconds. Let's see if we can do another question real quick from the ones submitted. Let's see here. Is there a formula? This one is from Tim. Is there a formula you use to determine the value of a startup? Startup capital plus user base plus revenue. Wow, Tim, it's a good question, but it varies so much industry from industry that I would be hesitant to answer that right now. And then from Glenn, how much capital has Onevest raised to date? What are the top 3 successes so far? And please just, well, okay, we won't have time for that one. But Glenn, if you're interested in working with us, we'll be more than happy to answer those questions. And generally, I can say that we are generally in a very good trajectory. I'm very proud of what we're doing in the industry, and we're not only growing, but our velocity is increasing. And so anyways, for all of those of you in attendance, thank you so much for participating. It was a pleasure. I hope that you found the webinar useful. And please, if you have suggestions as to content that we should include next time we do this, include it in your comments. And we look forward to staying in touch. Best of luck with everything.